Alright, so first of all, congratulations that you guys have cleared your FRM Part 1 exams. We'll start off with the Part 2 syllabus. So basically what these people have done, the GARP Institute has changed a lot of portion of FRM Part 1 as well as Part 2 curriculum for the 2017 examinations, right? There have been quite a few increases in both the levels exams, so the deletion has not been as such, but there has been quite a few chapters that have been introduced. Especially if we look at the Part 2 curriculum, the current issues portion has been changed quite a lot. So Part 1 we already know we had 4 subjects. One was the theoretical part, the foundations one. The second was the quants where you understood the whole statistical portion, the financial mathematics area. The third where you understood what's derivatives, what's the basic different derivative products and CCP and all of that, wherein and a little bit of corporate bond and little theory chapters over there in the financial products, markets and products. In the fourth one, you got into the valuation part wherein the VAR section was important, then the fixed income section was there, and there were a few other chapters again, country risk and foreign exchange risk and all of that. So the first level was basically building your base in finance. The second level when we move towards, there is absolutely no basics of finance now. We expect that you already have a very strong base of finance. The subjects that you'll be doing in FRM Part 2 would be your market risk. It's absolutely specializing in the risk area. The second would be your credit risk. The third is your operational risk. The fourth book actually has 2 subjects. The first one is your current issues in investment. So I'll just shorten it and write it as investment risk. And this is your current issues. So broadly, if you see, we'll now get into the specialization part of the risk management. The first level was just introducing you towards the basics of finance. Now, before I start off with this area, we discussed in FRM Part 1 as well that why is FRM, why is the risk management profession becoming important, the domain becoming important. The one thing that I discussed in level 1 was in the banking area is getting more of traction. There's a lot of more non-commercial banking business that is being done in the banks now. So bank is not a traditional, in a very traditional format as to, just deposit money or borrow money. There is much more in terms of the banking sector now. They have expanded into multiple variety of areas. The scale of operations has become magnanimous absolutely. The cross-border transactions have become so easy that even a 20 rupee or a $10 stuff you can buy from an Alibaba.com in China now. So the cross-border, the integration between world economies is so high that every other person, our lectures go all across the world, except for Africa, they are going everywhere at the moment. We are yet to have an African student now. So almost all the places we are covering right now. So even sitting in one city in India, we can do work, we can have our profession grow, we can reach out to more and more students, you can reach out on a global platform, and it is very easy because technology has made that easy. Because of that integration, the word contagion you've already studied, wherein one country to the other, in case there is a recession, in case there are issues, it trickles down from one country to the other. It spreads out like a disease, right? The correlations tend to increase during times of financial distress. Similarly, we had discussed there's something called the Basel norms that is very important because the banks now have to comply with the international rules and all. Now, since the banks are so integrated with each other, they have become so huge and they've become an international bank rather than a national bank, and their business operations are not restricted towards, just depositing money and lending money. It has grown way beyond that. That is why the banks have become very risky and we need to control their risk. The rules and regulations that the banks need to follow is laid down in the Basel norms. So that becomes a very important component when you study operational risk. About 30% chunk of operational, 30 to 40% chunk rather, or maybe even more bits and pieces in different chapters, you'll find Basel norms is covered very thoroughly in the operational risk segment. Now when you look at the 2007 crisis, the 2007 crisis was primarily driven by the financially engineered products. That's your mortgage-backed securities. Then we repackaged those into the CMOs, the CDOs and all. And that led to the crisis of 2007. So there was a huge credit crisis. If I have to give an example, people were so confident that if a bond has been rated BBB, even though it's a mortgage-backed security, it's not going to be defaulting. There were people who borrowed at AA or AAA rated bond. They sold AA rated bond to borrow money and invested in probably a A rated or a BBB rated mortgage backed security. And when you're depositing in that, you're expecting to earn a decent amount of revenue, because obviously the triple B or a triple B rated bond will be having a higher yield as compared to a double A or an A rated bond, because you're borrowing for a low credit risk bond and investing in a high credit risk bond. People were getting into CDSs, credit default swap. Credit default swap, I guess we did we cover in level 1? Because I can confused. CFA mein it's there. CDS nahi kiya na? So there is something called a credit. If there is a term, I must have discussed in FRM. Credit default swap is basically you buy an insurance. So there is this party A. He's the insurance buyer. So he buys an insurance, promises to pay a premium, let's say a 3% rate to this insurance provider. Now, in case bond X defaults, this person will take good of the loss, will make good the losses. Basically, when you buy a fire insurance, how does it work? There's one party pays an insurance premium. In case there is a fire, he's compensated for the risk, for the losses. In this case, what is happening? A is buying an insurance that this company X will not default on its obligation. And for that, it is paying an insurance premium. In case company X defaults, this party is going to compensate A. So basically, people have financially engineered such levels of products. People have financially engineered. Financial engineering, try to remember the example, MBS, Kingfisher, LIC. If you remember part 1 examples, we had discussed that whatever prepayments will come, first we'll give it to one company, and then all the later till the principal is exhausted for the first company, and then we'll pay it to the next company. So all the EMIs that you're getting, all the EMIs, principal plus interest plus prepayments, all that goes to first this company X, there is company X and there is company Y. Rather, let's keep it LIC and Kingfisher. This was your tranches. We had discussed tranches, mortgage-backed securities mein. In the chapter mortgage-backed securities, we had discussed tranches. So all the principal interest that is a part of EMI and the extra prepayment that comes in, you are going to be paying interest to both the parties. But all the extra amount of money is going to be used up to pay off the Kingfisher. Once Kingfisher's principal is exhausted, then the remaining money flows to LIC. That is a tranching, time tranching. So basically, your prepayment risk gets divided into two parts. This Kingfisher gets the contraction risk. I'll get the money jaldi, I'll get the money quickly, I'm scared of that. And LIC is scared that the money will be paid later, extension risk. So you divided the prepayment risk into two portions, that is a contraction risk and an extension risk. One party gets the contraction risk, one party gets the extension risk, and that's what they wanted. Kingfisher wants the money earlier, he's getting that. LIC wanted the money as later as possible, and he's getting that. Bolo, are we okay till here? Right. So because of this, so this is financial engineering, right? Where you're trying to repackage the cash flows, the financial securities in such a manner so that you can customize the kind of receipts or kind of cash flows that is going to accrue to these parties. So that you can customize these cash flows. So a lot of financial engineering was happening. A lot of credit risk transfers were happening. So now what happens is when you're dealing with such huge sums of money wherein large players are involved, it creates systemic risk. Now systematic risk is different, systemic risk is different. When you talk about systematic risk, that is your beta. What is beta? The sensitivity of the stock with respect to the market. If beta is equal to 1.25, that means market moves up by a percent, your stock will be increasing by 1.25%. Market falls by 2%, your stock is going to fall by 2.5%, 1.25 times of that, right? Systemic risk is that maybe a failure of one organization can trickle down to such an effect that the whole system, the whole financial system falls apart. When you're talking about the US crisis, Lehman Brothers falling was a systemic risk, because if one bank fails, AIG, the government had to come to rescue. Trillions of dollars were lost. Trillions, not even millions or billions. Think the number of zeros we are discussing. 6, 9, 12. 12 zeros. Trillions of dollars were lost. So now the risk management becomes very important. That is mainly going to be covered in the credit risk. How do you manage credit risk? The other party does not pay you the requisite amount of money. That is the credit risk part. The other party does not make good its payment, does not comply with its portion. That is your credit risk. Credit risk is not just restricted to the banking sector in the very traditional manner. I give you a loan of $1 lakh. You do not pay me that amount back. That is a credit risk. Even if I do not give you a single penny loan, even if two of us enter into a derivative transaction and you have a negative payoff, I have a positive payoff in the derivative transaction. We both entered into a swap. We both entered into a forward contract. At that maturity, it will be if you have an obligation to pay me the money, and if you default on that obligation, that is also the credit risk. So it is not just the credit risk being restricted to a very traditional form of sense, wherein you borrowed money and you forget to pay about it, or you're not able to pay for that money. It is also with respect to these kind of transactions. Party A is thinking that it has taken an insurance. If this company X will default, this person is going to make good the payment. What if this person defaults? Credit risk. So when we get into these kind of details and intricacies, central counterparty you studied. Now what if the central counterparty is going to default? So those things will be covered in the credit risk portion. So risk is becoming more and more important as we are tending towards more globalized, more integrated economy, larger scale of operations, so much of integration. So all these things are actually causing a lot of systemic risk. Earlier there used to be a statement too big to fail. You will find the statement again and again in operational risk. Some banks were considered too big to fail. Lehman Brothers, even on the day that it collapsed, just the moment before that, it had a slight expectation the government is going to stop that. The government is going to rescue this bank. They had that kind of an expectation even just the day before it was declared bankrupt. That the government will not allow, US government cannot allow the bank to go bankrupt. You're understanding the idea? So because of such kind of phases, it's become very important. So one is the Basel norm. Now when you look at the Indian context, we have the Basel norms being implemented by March 2019. So because of that, it's going to be very important that you understand your operational risk content very well. Second, the financial area, the financial institutions and the financial market is developing very quickly in India now, because we have the kind of growth potential. We have a BRICS bank coming up. We've got the Jan Dhan Bank scheme going on. If you look at SBI, then you've seen the demonetization scheme right now. So we're looking at a lot of development in the financial and banking sector, wherein the risk management part becomes very important. SBI, there was an article I was reading, SBI about 60 to 70% of the employees are stated to retire by the year 2020, or it was 2022, as far as I remember 2020. So there's going to be, we are expecting a good amount of demand, and everything is getting more and more automated, more and more system oriented. So the risks are not on a minute level, the risk is going to be at a very high level. Chief Risk Officer has become a very important designation in any kind of financial market, financial institution and the banking institution. SBI was searching for a CRO very recently, last 2 months before newspaper. I don't know what's the state right now, whether they've got one or not. Because you have a CEO, you have a CFO, you have a Chief Investment Officer in investment companies, you have a Chief Technology Officer when you talk about companies like Infosys or a TCS, because that becomes very important over there. When you talk about financial institutions, your CRO becomes an important phase, that is your Chief Risk Officer. So most of these things you already understand. The ERM, the Enterprise Risk Management System to be implemented and all. So risk management in itself has become a very important area. And even apart from the financial sector, it is also very prominent in the energy sector, wherein because the energy prices, the oil prices and all keep fluctuating a lot. Very commodity driven organizations, banking sector and any financial related institution is going to have a lot of applicability. Now I would not want to exaggerate something. Manufacturing sector might not have any relevance as such for this. The maximum relevance could be if you're into an iron and steel manufacturing, you can use a little knowledge about your derivatives to hedge the prices probably, or to try and understand the economy, how it's going. But on a very practical front, if you want to understand the energy sector, the banking sector and the financial sector, it's going to be quite important to study this content. The content is not going to be as numerical as what you had in level 1 curriculum. Level 2 is going to be partly less numerical. Level 1 was introducing towards finance. Now we are going to get into the risk management area, as you can see. So it's going to be hardcore risk management that you're going to be studying. Right. So we'll start off with so we have quite a few chapters added. Current issues, there's been a lot of changes. Couple of chapters have been added in all the 3 subjects. In fact, 2 chapters have been changed in investment risk as well. But the current issues curriculum was revised last year, and they've again revised the whole 100% curriculum. So earlier when I gave my exam, I had studied some Allied Irish Bank and very older current issues. Basically, current issues is standing for what are the current issues that our economy is facing. So those current issues you need to know about, because there was this article I'll keep on discussing these things during our classes. You should start reading, it's very important. So with respect to the current issues portion, the point is that when you make a mistake and you learn, your learning curve is going to go this way. Because you're making a mistake, you'll take time, you'll suffer because of that, and then you'll learn. But when you learn from others' mistakes, your learning curve is going to be this way. Because what they have learned by making a mistake, suffering, and then rectifying, you can learn by studying their mistakes and not repeating those. So learning from your experience is fine, but now it's the time wherein you need to learn from other people's experiences. So that's why I keep on focusing. Please start reading. Please start reading. It's very important. I share books as well. You WhatsApp 98304-97377 and WhatsApp that you need books to read. She'll give you the link to read books and all. That will be provided. So if you want those, just WhatsApp on that number that you need the books and all related to management, business and all. You need some books to read. So you'll get the books and you can start reading on those. So start reading. It's very important. So current issues. So last time what I studied was a little older version of Allied Irish Bank and all that. Last year's syllabus 2016 had the whole of current issues with respect to the 2007 crisis. So it was based on the US crisis. And this time I've seen the syllabus. I've not seen it pura, the whole thing in detail at the moment, but I've seen Bitcoin and a lot of different stuff that has been included, which is very current and very banking financial related. So it's going to be quite an interesting read to go through that, right? So we'll discuss every single chapter right now. I just wanted you to understand, what profession you're entering, what kind of a business or domain you're going to be looking at. All right, I'll tell you how to practice, from where to practice, how to study, in which order to study, and all those things. Your registration deadlines and all, I don't need to repeat it as when I introduce in FRM Part 1. Your exam takes place May 3rd Saturday, and it will be November 3rd Saturday. It's always the 3rd Saturday of the month. Your examination timing is going to be 2 p.m. to 6 p.m. It's going to be a 4-hour paper wherein you'll have 80 questions. For the 80 questions, you'll have 20 questions, 20 questions, and 20 questions. You have a 25% weightage for all the 4 books. This subject is going to have a breakup in the number of questions. You have 15% weightage, that is 12 questions over here, and a 10% weightage out of 80 questions, that is 8 questions over here. So your 80 questions are going to be broken up in this manner. The content is going to be less numerical, so you'll have to actually study, you'll have to actually put in time, study the content. I'll also teach you how are you supposed to be marking in your book and from where are you supposed to be studying, and everything I'll cover once I start getting into the details of the chapters. So this is going to be your exam format. Your classes would be approximately 100 hours plus. It's going to be, I think FRM2 is 120 hours. I'll just check and I'll tell you. So it's going to be approximately 120 hours or so. And for those who ask me, kitna time, how much time are you going to take to prepare and all. So if you've got 3 months, 4 months to prepare, say for example, February, March, April. Okay, so we're looking at 3 months to prepare. So take 4 months right now, exactly 4 months from now in case I take. You leave aside 15 days or 20 days for your revision and for your practice or something. So leaving that, you have approximately 3.5 months, that's about 14 weeks. That's about 12 weeks is for 3 months and 2 weeks extra, 14 weeks. So when you want to break down your 14 weeks, it's about 120 hours of classes. So 14 weeks, I would roughly say 10 hours of lectures you need to complete in a week. So now 10 hours, you do your 10 hours classes and you study that 10 hours, whatever was covered in those 10 hours worth of lectures, you need to complete that much from your textbooks. That is how you plan your schedule. So someone who's starting a little late and has got 2 months, say for example 2.5 months left, so 2 months is 8 weeks for about 120 hours of lectures. You just divide 120 by 8, you need to cover around 12 to 15 hours of lectures per week. 12 to 15 hours of lecture. It's not that scary. It sounds scary, 120 hours, it's not that scary. Because once you do the class, then reading the chapter, when you read the chapter by yourself, you'll take 6 hours and it will be very difficult for you to imbibe everything, to understand everything. But once with the classes, because we go with the books. So once with the classes, it will take you hardly 2 hours to do the classes and it will take you another hour and a half to go through the content. So that will reduce and your registration will be higher because you're doing it twice. You'll take 6 hours to do it yourself once without understanding properly, and once you have the classes, then you can do it in 3 hours. You do the class for 3 hours, another 2 hours you add on, and the whole chapter is done with double the registration and the understanding. The understanding is going to be important because the questions are still MCQs, 4 questions each. It's going to be 4 options each and 1 MCQ. There are 80 questions. At times, At times certain practice papers and all I've seen, now what they do is they do not generally give an item set that's there in CFA level 2 and 3, but it is possible you'll get a full passage, you'll get a huge question written, and you'll have 2 questions based on that. Not more than that. I generally don't think they are going to go that way, because it's generally a simple straightforward question options, but it is possible you'll have a good sizable chunk of question, and then you'll have the 4 options each on 2 questions. It is very important that you're practicing, because without practice it's not going to help. So practice is going to be very important. I'll tell you exactly from where to practice. Let's just understand the syllabus once, then the order of study, how to revise, how to practice, and all those things we'll discuss. So I'll start off with in the serial order. I'll start off in the serial order with your market risk portion. Now you'll have to give me a little time with it. So when we are talking about market risk, the market risk syllabus can be divided into broadly 3 portions. If you check the index of your books, we'll be following Schweizer throughout the classes. So you will need to purchase the Schweizer books yourself. I do not provide the same. So you can refer to Schweizer books. We will be following the series or the order as per Schweizer. So that will be your core book. Whatever extra I'll make you write, I'll make you underline most of the things in the textbooks itself. I will also be making you write a lot of things, but most of the things are going to be written within the textbook itself. And whatever extra where there needs to be little handouts and all those given, that will be provided to you, right? So when you talk about notes, it's going to be mainly inside the book itself. So your core book is going to be your Schweizer books that you'll use. Whatever extra is needed, I'll give you, so you don't have to refer to another book apart from Schweizer. The practice material that is needed, everything will be shared with you on a soft copy, and a hard copy of a practice textbook will also be given. So whatever mock papers are to be given, whatever practice material is to be given, it's my responsibility. All you need is this 4 textbooks of Schweizer, 1 practice book you get along with Schweizer, that's all you need. Apart from that, anything that is required to be given will be taken care of by me. Of course, I'm assuming you have your calculators already, obviously. So Schweizer you need to purchase yourself. The rest of everything that is there, any extra notes is there, any practice material, any online practice material, everything is going to be my responsibility, right? All right. So when you talk about the first book, your market risk portion, so market risk is wherein currency rates change, interest rates change in the market, any equity related changes are there in the market. How does it impact your valuation? How does it impact your market prices and all? That is the market risk portion. If I have a position in derivatives, say for example, I have a portfolio of call options. Now, if the person who's the counterparty in my derivative contract, if he does not pay me the money, that is credit risk. If there is a theft, system failure, any of these kind of issues, that goes into the operational risk. How to invest something, that gets into the investment risk. But when I'm talking about if the interest rate changes, how is it going to impact my portfolio of call options on the bond of so and so company, that is going to be a part of market risk. That is your market risk. You already understand. Legal risk, litigation risk, what's the difference? Legal risk and legislation risk. Let's see how much of part 1 are you clear with. What is the difference between legal risk and legislation risk?
The rules and regulations governing a particular country would constitute legislation risk, I guess. And legal risk is when they are operating in different countries, so they have to abide by the
No. So the first one is correct, the second one is incorrect. So when you differentiate between a legal risk and legislation risk, I hope you know. No, not fair. Legal risk is when Nestle had that issue with the Maggi being banned because of the lead content in the noodles. That is a legal risk. A risk with respect to a particular company getting into a litigation, getting into some kind of a court case or some kind of a trouble over there. Legislation risk is when the government of Delhi, when the Supreme Court or the High Court, I'm forgetting which, I think it was the Supreme Court which held a ban on 2000 cc plus diesel vehicles. That impacted the sales of Audi and other companies. So legislation is not indicated towards a particular company in general. It is a court law. It's a law that is passed, a regulation that is passed, which might be detrimental for your company's sales. That is a legislation risk. Legal risk is when because of a company's action it gets into some trouble. So that becomes more of a company specific. And legislation is more of a general rule that might, impact you adversely. Like, right, that is in the legal risk. The trigger being company's actions is in case of the legal risk. Now say for example, if you increase the export duty, or something on gold, we were not export duty, on gold we were planning to have excise duty implemented. right? So that becomes a legislation risk. But when Gitanjali Gem and Jewelers got into some corporate governance issues, that becomes a legal risk because that is because of the company's actions. So when you're looking at, the differences, systemic, systematic, legal, legislation, you need to understand the content really well. Because if you read systemic as systematic and try to answer the question, obviously you'll be marking the answer wrong. Right, so you need to understand it's going to be less numerical and therefore more, you understand that you've given part 1 exams, it's easier to answer numerical questions with confidence as compared to answering non-numerical questions with confidence. With the part 1 examination, you must have had an experience. It's more difficult to answer non-numerical questions as compared to numerical. Because the numerical questions, you can always understand the answer. You can calculate, you know the steps, you know how it's going. Because it's very much in front of you. But over here, it's going to be far less numerical and much more conceptual. I tend not to say theoretical, but more of conceptual. It's going to be way more conceptual when you look at it. Bolo, are we okay till here? Right. So market risk, we have 3 sections. The first section, we've got about 6-7 chapters that is talking about mainly focusing into VAR, the value at risk portion. The second 3-4 chapters, I'll make you mark in the textbook and all. The second 3-4 chapters is going to be dealing with the correlation portion in detail, because correlation becomes a very important factor when you're trying to determine the market risk in all these factors. And the last portion is going to be dealing with more of the interest rate section. And there's a last chapter, very simple, volatility smiles chapter, that is not related. So few chapters on VAR, 3-4 chapters on correlation, and a few chapters more to do with the interest rate and interest rate structures. Because interest rate is going to be impacting your market prices, correlations are going to be impacting your portfolio diversification and market prices, and value at risk is a very important measure when you talk about measuring risk. So when we are measuring market risk, value at risk becomes very important. Just give me 1 second. So if you want to take down readings 1, just note it down, 1 to 5, take 1 to 5, actually 1 to 4 dash VAR. Chapters 1 to 4 is mainly related to the VAR section. So once you have the textbooks in hand, since most of you do not have textbooks right now, if you have a textbook, you could mark in the book itself. But otherwise 1 to 4 is going to be VAR related, so you can mark in your textbook's index itself. Chapter 5 is a new intro, chapter 1 to 5, 1, 2, 3, 4, 5. Okay, there has been a chapter deleted. There's a chapter that has been deleted. Right, so 1 to 5 is going to be VAR, just correct that. Chapter 6, 7, 8 is related to correlation. 6 to 8 is into correlation. That is your sum correlation basics, empirical properties of correlation and statistical correlation. 6, 7, 8 and even 9, financial correlations. Chapter 10 onwards, we get into the 10 to 15. 10 to 15 is more to do with the interest rate section. So the reason why I'm making you mark these in indices in your chapter indexes, when you're studying, suppose you want to switch between 2 subjects. Now if you look at it that way, market risk, these subjects are not related. These subjects are not related. So when you want to study market risk, I expect you to do chapter 1 to 5 together. Don't mess around with the VAR section. Like if you're doing VAR, at least do the whole VAR section together. Then after 1 to 5 is done, then if you want, you can make a switch to another subject. Then you get to market risk, your correlation portion needs to be done together because they are related chapter. That is the reason why I'm making you mark the chunk. So you'll understand, this chunk is to be done together. So even when I'm doing it in class, I'll do it in chunks. This chunk is done, maybe I'll switch to another subject if need required. Right, so I'll give you the order of, in which order we should study, but you should always identify the chunks. When you're revising, when you're studying, whatever you're doing, the chunks need to be done together. You're not going to be messing around 1 chapter here, 1 chapter there, 1 chapter here. Your registration will be low. And what happens is, a similar content when you study in 3 places, you tend to get confused. That, I studied this, no, I studied that. So you need to be very careful as to, okay, this was this part, this was this part, this was this part. So the related content needs to be studied together. So whatever chunks I'm making you mark, you need to study that together. You're not going to be segregating those, right? Okay. So, and the last chapter, that's your last chapter, that would be 16 is your volatility smile. 16 is your volatility smile, that's a standalone chapter. So we've got 3 chunks and 1 standalone chapter, volatility smile, that's an easy one. Important one though. It's very simple, small chapter. So let's go one at a time in the market risk section first. So when you're talking about the value at risk, portion, the first chapter is into estimating market risk measures. So estimation of market risk measures would have a lot of computation of VAR, log normal VAR. So basically the computation part of value at risk, expected shortfall, if you recall, expected shortfall was what portion? Expected shortfall was, VAR was this particular point. The probability, there is a 5% chance that my losses will exceed this level. This was VAR. But what if my losses do exceed this level? Then what is your expected losses? You don't know about that. What if my losses are exceeding this level? Then what is going to be my expected loss? You don't know that. Expected shortfall. So we try to find out the average losses only in the tail, and that gives you kind of a conditional value at risk. There were different names to it, conditional value at risk. If I am falling in this tail, conditional upon the fact that I'm on this side of the tail, what is the risk? Conditional value at risk, expected shortfall. So these kind of measures we had done in level 1. We'll dig a little deeper as to how the calculation will be done. So that's your first chapter. In the second chapter, we get into non-parametric approaches, which is very interesting, wherein the simulation techniques and the historical methods and all of calculation value at risk is what we study. The third one, parametric approaches, is the chapter that has been deleted. Parametric approaches was very high level kind of statistics, which was very theoretical, and there was no numerical covered, so they've deleted that chapter, and that's for good. Backtesting VAR becomes very important, and you'll see the application of backtesting VAR in a place when we'll do the operational risk chapter. Now, what is backtesting VAR? Let's try and understand. I'm just giving an introduction, right? So you just get an idea of what kind of content we'll be covering. Now what happens is, suppose I have calculated, my model has been used, I have calculated value at risk to be equal to minus 1.87%. Now what I do is, I need to backtest this model. Based on this model, my probability, the probability that my losses will exceed a 1.87% is 5%. Suppose I collect 200 days of data. Out of 200 days of data, if this model is absolutely accurate, 5% of 200 days is 10 days. If this model is accurate, only 10 days out of 200 days, my return should be lower than minus 1.87%. Now, if say for example, the return is lower than 1.87% out on 12 occasions, on 12 days out of 200 days, the difference too is known as exceptions. How many exceptions are there? What kind of, if there are too many exceptions, that means your model is not working well. If your model is not working well, that means how much capital the bank needs to maintain. I have taught you that in operational risk in the last level, wherein we had to talk about how much equity needs to be maintained based on the operational risk of the bank, that jitna risk bank lega, the amount of risk the bank is going to take, according to that it needs to maintain equity, because you cannot, this debt portion is a huge portion. Try remember, whatever amount we people deposit in a savings account, in a fixed deposit account, in a fixed asset account, all those are liabilities from the bank's point of view. If I have a fixed deposit or a current account or a savings account, whatever be it, it is a liability from the bank's perspective. Bank cannot say that I am bankrupt, I cannot give you money. People will lose faith in the banking system. There will be no savings. The whole financial economy is going to fall apart. The whole point of demonetization was to bring money in the economy. The recent one that we've gone through, right? So it becomes very important to put money in the economy. You cannot have a bank fail. People will lose faith in the financial system, in the government. Sarda scam was a big blow to at least the economy of West Bengal, and we are suffering when you look at the kind of growth we are having in our state. Are you following what I'm talking about, right? So how much of equity do you need to maintain? How much of capital do you need to maintain is a very important part over here in the Basel section. And don't you think the number of exceptions will be included, will be used in order to determine if there is extra capital needed? Your value at risk models, the banking model and all need to be tested. You've done stress testing in level 1, you've understood value at risk, now we'll do stress VAR, we'll calculate stress VAR and all. So those kind of calculations we will be doing. Are we okay till here? So backtesting VAR is going to be something related to this, and how extra capital is needed and all we'll be studying. Then the next part comes in VAR mapping. That is again a similar content wherein we'll try to understand how to calculate VAR for different derivative products, etc. Right. Then the academic literature is about VAR models, stress testing, and it's more on the theoretical grounds, but it's very interesting content at the same time. The balance sheet measurement, how do you aggregate risk? So you have different departments, how do you put together the value at risk of the whole department as a whole? So all those things will be covered. If you notice, I'll just show it to you. I don't know if you'll be able to see it from that far, but you'll need to put in your content in such a manner, you'll need to put in your content and mark in such a manner that during the exams you're not reading anything that is not underlined. So whatever you underline, whatever extra I'm making you write, that is going to be very much sufficient to cover for the exam. Of course, you'll have to study the whole content for the first time. But you know that addition needs to be there, because during the exams, 85 chapters, how will you revise? How do you expect to revise 85 chapters, 85 readings? It becomes very difficult, right? So we'll have to shorten the content, we'll have to understand, we'll have to mark it. So all those things will be needed, right? So this is more or less your first section. Correlation, I'm not getting into details because you already know the correlation, the ratios, correlation between swaps. When you're talking about correlations, Spearman ranks correlation, concentration risk, all those things will be covered. So the 3 chapters are going to be very, very number related, number oriented. Different kinds of correlation, different kinds of ways in which correlation will be changing is what we'll study. Once the correlation portion gets over, we get into the prediction of interest rates. How do you hedge your risk? When you talk about duration, you've done regression. That's you form an equation y is equal to b0 plus b1 x1 b2 x2. You've also done duration. You've also done key rate duration. Now how is the hedging going to work? A single variable hedging or a 2 variable hedging, those things we study. When you're talking about duration, it comes down to the interest rate portion, right? Term structure model. Now when you talk about term structure model, you know what is spot rates, you know what are forward rates. You need to be able to draft, you need to be able to create a term structure. Term structure as in, how are your interest rates going to be looking like over maturity? Generally we have an upward sloping curve because of maturity risk. Longer term bonds have higher rates of interest, right? I'm seeing a little blank expressions.
Yeah.
You remember level 1 content? No.
I do, but then
You'll have to, level 1 basic, why did they do all that in level 1? It's not that without knowing level 1 you can clear level 2. Your understanding, your basics need to be very strong. So the interest rates, puttable bonds, callable bonds, how are we going to be having their interest rates and term structures looking like? That we'll need to see. The evolution of short-term rates, we have reading 12. We get into a flat yield curve, an upward sloping yield curve. We'll talk about the convexity effect. We'll try to create binomial trees and all. We'll try to assess how the risk premium is going to be calculated. When you talk about interest rates, that's equal to your real rate plus inflation premium and plus your risk premium. So those portions. Then there is a term structure model. We'll have a lot of different models to try and predict the long-term and short-term rates. That's going to be a relatively complicated chapter, right? And the next one, we talk about the volatility and the distribution. So you not only study about the interest rates and what the interest rates are going to be looking like, but also the volatility, how much of volatility between the interest rates are going to be happening. So that we need to see. The last part of your interest portion of the market risk interest rate portion is your OIS discounting, credit issues and funding costs. So basically you've done something called a LIBOR rate. There is something called a swap rate, the rate at which two parties can get into a fixed and a floating swap. Now the fixed and the swap rate and the difference between the swap rate and the LIBOR rate, that is the LIBOR OIS spread, the funding rate, the rate at which US government is willing to give you money, or banks can borrow from the US government rate. Let's say we talk about the treasury rate. Now we talk about the LIBOR rate. The difference between the LIBOR and treasury rate is going to give you the riskiness of the banks in comparison to the central bank. Because if the central bank is offering 4% and LIBOR rates is the rate at which banks can borrow from each other, let's say at 4.5% or 4.75%. That 75 basis point difference, that 0.75% difference is indicating what? That is indicating that if you take from the government, it's a 4%. If you take it from other bank or if you deposit it in another bank, it's 4.75%. That is the banks, the credit riskiness of the banks is indicating a 0.75% spread. That is the credit spread of the bank over and above the government or the treasury or the central bank. So those things we'll study in the OIS and the spreads chapter, right? And then we move to the last section. That is your volatility smiles. So volatility smile is more to do with the option section and how the volatility changes over the term structure or the strike prices. So how is the volatility going to shift? For equity options it's different, for currency options it's going to be different. So you'll have an x-axis, how volatility reacts to, let's say, exercise price. For currencies, for equity, so at higher exercise prices, how is the volatility? At lower exercise prices, how is the volatility? So we are going to study how volatility affects and how volatility changes. So that has got nothing to do with the rest of the chapters. So we've got a section on VAR, we've got a section, small one on correlation, a decent section, quite a decent section on the interest rate portion, because interest rate is a very important factor when you're trying to value something, the market risk part. And the last part is your volatility smile, which is a fairly decent chapter, right? That covers your market risk. Market risk and credit risk, to be honest, operational risk is a bulky, the irritating, or the wherein people find it very difficult because it becomes very hefty, to include it, to understand that, not understanding actually, but to include the content to an extent even understanding portion, because it's so huge, you lose track of what you're studying. So those things come in operational risk. Market risk is a relatively much more interesting component. Market risk, credit risk, and even the last one. This part is going to be very interesting for your term, but operational risk tends to be a little boring. So, be prepared. It's better to know that, okay, boring hoga. I know it's going to be boring, so let me try and, study in the morning hours or in those hours where I can make it relatively more interesting from my point of view. So that is why I was indicating that. Alright, then we move to the credit risk portion. Credit risk, you'll have chapter 17 onwards. That's your reading 17 onwards, credit decision. So when you look at credit decision, credit analyst and default risk, one second, credit analyst, classification and key concepts of credit risk, and rating methodology, a new chapter has been added. So if you could mark 16, one second, spread. 16 to 21. 16 to 21 will be one section. 16 to 21 will be one section. 17 to 21, sorry. 16 was volatility, smile and market risk. 17 is your credit decision. 17 to 21, credit decision, credit analyst, classification and key concept of credit risk, rating assignment methodologies, risk, credit risk and credit derivatives. All that is going to be one chunk, wherein we'll be doing basics of credit risk, and it will be a fairly decent part. Chapter wise I'll explain. The next section is going to be spread risk onwards, spread risk, portfolio credit risk, spread risk and default intensity models, portfolio credit risk, structured credit risk. That is going to be one section. Defining counterparty risk onwards, defining counterparty risk would be section 25. So we have one section is your 17, 18, 19, 20, 21. 22 to 25 is one section, 22 to 24 is one section, 25 is your defining counterparty credit risk, onwards, netting, collateral, center counterparty, till 28 is one section. 29 credit exposure onwards, credit exposure 29, 30 and 31 is one section. 30 and 31 is one section, including 32 also, wrong way risk also falls into this section, and 33 is a standalone chapter, credit scoring and retail credit risk management. 33 is a standalone chapter. Then 34, 35, 36, 34, 35, 36 and including 37, that's all one chunk. In fact, 35 to 37 is the same component. 34 will go in the previous component with 31, 30, 31, 32. The default probability, the credit value adjustment, the central party. So evolution of stress testing for counterparty would be in the same section. Are we okay? So the first section basically, credit decision, credit analyst and all, is relatively easy and theoretical. The second section becomes quite difficult, wherein we discuss the portfolio credit risk, the structured credit risk. So what is the credit risk of the whole portfolio as a whole? So that is what we study in the second section. The third component, defining counterparty risk, netting collateral and all, is going to be related to the CCP portion you did in level 1. When you do the central counterparty, the netting wala part, collateral wala part, so you know collateral, counterparty, netting of all those sections when we are talking about, we'll be discussing in the third component, that is your collateral, central counterparty and all that, CCP section. Then the credit exposure, default probability, credit value adjustment, wrong way risk and all are very interesting concepts, something relatively new as compared to what you've done. And the last study session, the last portion, the last section is more to do with the subprime mortgage. So MBS, mortgage-backed securities. So in case your mortgage-backed security is a problem, you're more than welcome to do the level 1 class again. You can attend that if you have issues with concepts and all. And also if you want, there is a 15-minute video online. You can see that on my website. You'll find key concepts. You can go to the video section. You can go to the key concepts. You'll have quite a few lectures over there. So you can check that portion. Now let's just see this in detail. You understand the way credit risk is broken up. So now when we start off with the first section, the credit decision and all, that is very basic as to who require credit risk, what is credit risk, what is probability of default, what is failure, what is insolvency. Very basic terms have been discussed. The second chapter is discussing a credit analyst. So say for example, you're working in the credit department of a bank. As a credit analyst, what are your qualities that need to be, what you need to understand, what kind of profiles people have. So you could be valuing auto loans, you could be valuing clients for a bigger home loan. So there could be different varieties in which you could be evaluated. So what are the different ways in which you categorize a credit analyst? One could be on a consumer sector or a business sector. One you could classify based on, you know, your designation, you're a management trainee, you could be an assistant manager, general manager, those ways. So basically a profile of a credit analyst, the role of a credit analyst, the responsibilities of a credit analyst, what kind of qualities, what kind of information should credit analyst have? As a credit analyst, someone who decides whether to give a loan to this person. Credit analyst could be based on credit card loans, home loans, auto loans, business loans, small business loans, personal loans. Are we okay till here? So these are the things the credit analyst is going to discuss. One second. The next one is your classification and key concepts of credit risk. We'll be discussing mainly terms and all related to credit risk. Ratings assignment methodologies I'll have to tell you later once we start with the content, because that is a new content that has been added. That's a new chapter that has been added. One second. Your second chunk for credit risk, the first one is 17, 18, 19, 20 and 21. Second chunk starts from 22. So that is, there's no name as such, it's like spread risk, more of calculations of credit risk on a portfolio perspective or a structured risk perspective. So that is the part. The next one is your credit risk and credit derivatives, where we discuss more of credit spreads and credit default swap and subordinate debt and applications and credit risk models, the PD, LGD, Moody's model, the KMB and all that you've not done in level 1, sorry. How to express the debt as an option for a company. How to express your debt as an option for the company. I'll just briefly do that for you. Say for example, you are looking at the balance sheet of a company. I'm doing it from an Indian point of view. So we have assets over here, we have equity over here, and we have debt over here. Right. Now, think of your equity as a call option on the assets of a company, wherein the exercise price is debt. Just think, equity, what is equity ka payoff? If asset is above debt, the payoff for equity is asset minus debt. If the asset value falls below debt, the payoff for equity is zero. So don't you think equity is like a call option on the assets, wherein the exercise price is debt? Whatever is above debt you'll get. I have the right to buy at debt level, and the extra portion becomes your equity. So how do you use the binomial model or the Black-Scholes model? How do you transform the whole equity valuation in terms of options? Even the debt portion can be replicated using options. Now, debt portion could be like buying a risk-free debt and selling a put option on the asset of the company. Think, if you sell a put option, now see, debt is going to get how much? The risk-free rate, if nothing is going wrong, correct? You have, it's like, debt is like RF purchase and put option sell. Had you not taken any risk, you would be earning RF. You're selling put option, you're earning what? You're earning put premium as well. Now, in case the company defaults, so Obvious सा बात है ना, if you are investing in a company which is credit risky, you should be earning more than RF. So what is the extra part that you're earning? Put premium. In that part, if you think, if the company is going to do well, what do you receive? Nothing extra, P0 minus, the option will expire and you'll receive nothing extra. Whatever is your face value, that is all you get. That is what happens. But if the company performs poorly, if the value of company falls, if the value of asset falls below the level of debt, risk-free, you'll get your face value. And what is the extra amount that you need to give? The debt minus asset portion. What is the payoff for a put option, put seller? The value that has fallen below the exercise price, you need to compensate that portion, right? X minus S, exercise price minus stock value. Exercise price minus stock value. So don't you think we can compare the debt portion with a put option and a risk-free bond? So how the option premium will be used, how do you calculate the credit spread, how do you try to find out that rate portion, all those things we'll study. That part becomes a little complicated. So this is the kind of content we'll cover. So it's not going to be a very easy, simple credit risk component that you've already done. We'll move quite a few steps forward. Are we okay till here? The next part is your credit and counterparty risk, wherein it's more of terminology, easy terms and all are discussed. Moral hazard, market risk, credit risk, counterparty risk and all those things. And we introduce this portion. This is your Merton model. This is a part of your Merton model. We start off with this portion and that portion is further continued in the later chapters. The spread portion that we start, the next chapter that we start, the spread risk and the binomial distribution and all that, we use a hazard rate, we try to do a lot of calculations, we try to compute the credit spread and all. I'll not be able to explain you the content in short right now for that component, the spread risk and all, because it's fairly complicated. Portfolio credit risk would be wherein we'll try to find out the value at risk, the credit value at risk of a portfolio of bonds or something, right? So again, the correlation becomes very important over here. The correlation, when you're trying to find out the credit risk of the portfolio as a whole, the correlation chunk will become obviously an important part, and the correlation part is going to be used when we are calculating credit value at risk. We were calculating normally value at risk when we were doing the market risk subject, but when we get into the credit risk portion, we'll have to calculate the credit value at risk portion. Tell me, are we okay till here? Are you understanding? You don't need to understand the content, you just need to understand, okay, these are the kind of things we'll study. Are we good? The next part is your structured credit risk, wherein the structured, what do you understand by structured? Waterfall structure, structured products, MDS, ABS, CDS, CMO. So those kind of structures, uska we'll be studying. How do we how do we discuss the credit risk of those kind of securities? Then it's a very simple part. We get into the counterparty section, wherein what is the counterparty risk? What is the mitigation measures? How do you net out? If you remember, this chunk I had done again in level 1. If you remember this chunk, say for example, A and B have got certain amount of money that B needs to pay A and A needs to pay B. A is supposed to be paying 100 to B and B is supposed to be paying an 80 to A. What if A goes bankrupt? There is a clause of netting that is very important. In case A goes bankrupt, if netting is not included in your contract, B will first have to pay 80 to A. Then if A's estate, if your loss given default is 50% or let's say 60%, so the amount recoverable is only 40%. So out of the asset of A, out of the 100 amount, B was able to recover only 40%. That is 40. So B paid 80, received 40, ended up losing 40. Your practical idea would tell you, I am supposed to be giving 80, he is supposed to be giving me 100. Let me have a loss of 20, I'll not give him anything. That does not work always. There is a clause called netting off. So the netting off clause tells you whether if A is bankrupt, B will have to make the payment because B is not bankrupt. If netting is not allowed, B will have to pay the 80 amount. The total asset of A is going to be liquidated, used up to pay off the creditors in their serial order. First you pay the secured debt, then the unsecured debt, and depending on that, B will receive its proportion of money, the recoverable amount. If the netting off clause is there, in that case, B does not need to pay 80 and the net amount payable from A to B is 20, and of that 20, any percentage needs to be taken care of, whatever be the recovery rate, right? So these kind of clauses we had done. We had studied what is a central counterparty. Instead of A and B transacting together, all A, B, C, D, E, F will be transacting with a central counterparty in between, and that part is going to be very important over here. Right. So the next few chapters, central counterparty, collateral. So how much of collateral needs to be maintained? So all the terms and conditions with respect to collateral, very interesting content is there. The central counterparty, the CCP failure, so all those things we study. And the credit exposure. Credit exposure becomes a fairly simple chapter. Lot of graphs are there, so it becomes relatively, it goes a little easy. So credit exposure is as to, now when a bank is giving you a loan, if I have taken a loan of $1 lakh from the bank, I don't have a credit exposure. The bank has a credit exposure that I'll not pay the bank. But it's not always about loans, right? Now what if the bank has given me a loan of $1 lakh and there is a collateral of $80,000? Immediately you will tell me that the credit risk, the credit exposure is for only 20,000 part. Actually it's not true, because the collateral itself might have volatility, the value of collateral itself might change. So how do you calculate the credit exposure part? What is the exposure? Now say for example, two of us get into a currency swap or a normal fixed interest rate swap. What will be the credit exposure? The credit exposure is with respect to all the future payments. It's not with respect to the notional principal. It's with respect to the future payments, and that too netted off payments, because in a currency swap or an interest rate swap, the payments are netted off. Currency swap may, the principal is also exchanged, so that will create more credit exposure in that case. So how do you measure the credit exposure? Credit exposure need not always be between a borrower and a lender. Now when we discuss credit risk, even counterparties to a derivative transaction have credit exposure, right? Credit exposure will be with the person who is making profit. The person who makes a profit has credit exposure because he has an amount receivable. The person who has a payable does not have a credit exposure. Credit exposure rests with the person who has a receivable amount. Are we okay till here? Everybody? Sure. Okay. So it's quite interesting that way. Again, you'll have to do a lot, we'll consolidate the content, we'll shorten it and all. The next part is your default probability and all, which is relatively numerical, risk neutral approach. There are different approaches, tranches, credit default swap, synthetic CDS, and all those things we study. I'll not be able to discuss it in detail, that part. Credit value adjustment. Now in case someone goes for a netting, in case someone comes up with a collateral, so what are the different ways in which your credit exposure can be altered? Suppose I want my exposure is at this level. If I go for a collateral, my credit exposure would reduce, right? So credit value adjustment would be dealing with that part. So in this chapter, we'll discuss with the credit value adjustment. Now, wrong way risk is a very interesting chapter, wrong way risk, and it is present quite a good number of times throughout the whole content of credit risk. So you'll find the wrong way risk a good number of times. Credit risk is going to be very focused on the mortgage-backed security portion, MBS, ABS chapter. So your understanding of the mortgage-backed security chapter should be well. In case you have a problem, you come for the FRM1 class. FRM1 mortgage-backed security class, you can join in. Right. Now mortgage-backed securities and all those things are going to be very important. So how do you value what is a wrong way risk? Okay, I'll discuss the same example. A is paying a 3% insurance premium to XYZ Insurance Limited. I'm writing insurance so that it's easy for you to understand. We'll discuss these things in detail, so please do not worry. A is paying a 3% amount, a 3% premium on a regular basis. If Lehman bonds default, if Lehman Brothers bonds default, this person is supposed to make good the payment. Now think of it from that perspective. What if XYZ Insurance Company has invested in Lehman Brothers? If Lehman Brothers defaults, the credit valuation of this company goes down. The rating of this company goes down. This company, this insurance company, has a lot of investment in Lehman Brothers. If Lehman Brothers defaults, don't you think this company becomes very risky? You will have a positive payment for this company when this company becomes risky. Just think of it. If Lehman Brothers does well, you are not going to receive any money. And when Lehman Brothers does well, this company is not risky. This company has got a solid investment. When Lehman Brothers is failing or doing badly, doing poorly, this company's asset base goes down. This company becomes more risky. So you are demanding money from the company at a point of time when Lehman Brothers is going to go down. Don't you think it's a wrong way risk? I need money from you when I know that you are going to be in a trouble. When you will be in a trouble, that time I need money for myself. So don't you think that is creating a wrong way risk? It's a wrong way risk. So these kind of things we study in the wrong way risk chapter. This completes this section. Credit scoring and retail credit risk management is for those retail credit, as in for households, for credit cards, for retail, short amounts, small amounts of credit to a larger audience. So that is what we study. That's a different part from the rest of the chapters. It's not very related. And when you talk about the rest of the content, evolution of stress testing, counterparty exposures, again the CCP portion, but it's a new chapter, so I'll not be discussing. We need to have the books before we can, get into the details of that chapter. The next part is your credit transfer, introduction to securitization of subprime prime mortgage. The whole thing is going to be dealing with the ABS, MBS and securitization section. So the whole part as to, tranches, collateralization, over-collateralization, credit enhancement, prepayment risk, all those things, the Kingfisher example, the planned amortization class and the support tranche section, all those things are going to be repeated over here. CMO, CDO, ABS, MBS, waterfall structure, bankruptcy remote vehicle, all those things is what we cover in the next part, the credit derivative structure. The credit derivative section. Bolo. Are we okay till here? Credit risk, we have sorted. Alright. Next we look at the operational risk. We move on to the next book. That's your operational risk section. Operational risk, if you see, I'll talk about the second half first. I'll talk about the ending portion first. The first half of the book has got a lot of different chapters. If you see the section, just give me 1 second. You'll have chapters 59 onwards. If you see, 59 is Basel 1, Basel 2 and Solvency 2. Basel 1, Basel 2 and Solvency 2. 59 is that. 60 is Basel 2.5. 61 is again fundamental review of the trading book, that is again banking related. 62 is Basel 2. 63 is Basel 3. 64 is Basel 3. 65 is again revision to the Basel 2 market framework. So you can actually mark 59 to 65. 66 is also Basel. 67 is minimum capital requirement for market risk. So 16, what did I say? 59 onwards until 67. 59 to 67 is the banking and Basel part. 59 to 67, that whole chunk is going to be banking to Basel part. Starting from Basel 1, Basel 2 and solvency and ending up to Basel 3 net stable funding ratio. Are we okay till here? The rest of the chapters you could find relatively, maybe some chapters are easy and theoretical. When you start with operational risk section, I'll just have to go through it once. The first chapter 38 is principles of operational risk. 38, 39 is enterprise risk management. You know these contents. 38, 39, 40, 41, 42, 43. So until 43 it's theoretical easy stuff. So till 43 would be one chunk, 38 to 43 would be one chunk. 44 would be separate, 44, 45, 46 will be a little different. '47 as well, 48 as well. So the chunk till 48 is another section, you can just keep it as another section. There will be different chapters are there till 48. Now your 49 and 1 second. 49 is again going to be Basel related. 49 risk capital attribution is again going to be more of Basel related, or you could keep it in the same segment. Range of practices issues is then 51, 50, 51, 50, 51, 52, you could keep it as one section. There's no name, it's still, you can't just group it. 53, 54, 55 is going to be liquidity section. 53, 54, 55, and in fact, you will need to include 64 and 67 in that, 66 in that. So just take the chapter's name, 53 onwards. 53 is your estimating liquidity risk. 54 quality of risk measures, will include it over here. 55 is liquidity and leverage. And then 64 Basel 3 liquidity coverage ratio, that is your short term liquidity, and chapter 66 Basel 3 net stable funding ratio, that is long term liquidity. So when we'll be studying, you are going to do 64 and 66 together with the liquidity portion. The chunks need to be done together. 64 and 66 needs to be done with the liquidity portion together. Your chapters 57 and 58 is again, 58 is a new chapter we'll have to see. 57 is also going to be a part of your Basel. 56, 57 both are going to be a part of your Basel. Failure mechanics of dealer banks, stress testing banks and all, we'll put it in the Basel section. So throughout the operational, even in the beginning chapters which I've not put it under Basel, throughout the section if you'll see, the most of the content is very Basel centric. It's very around, it's around, you know, so Basel norm need not be only operational risk, right? Even when you're talking about the liquidity risk, Basel norms could be coming in. What is Basel norms? What are Basel norms? Basel norms are going to be regulating the banking structure, the risk in the bank. So even when you talk about the stress testing, what does Basel have to talk about? The stress testing for the banks. What does Basel have to talk about? The liquidity part of the bank. What is Basel got to say about the market risk of the bank? What is Basel got to say with the operational risk of the bank? So when you look at the operational risk section, the first portion is relatively theoretical and easy, but the second half gets into too much of Basel norms, right? Once I do these chapters, I'll also make you mark a 3-4 chapter section, which you need to do the class, see the notes and markings, and you don't need to prepare any more from that. Because institute guidelines also mention that this chapter is for your knowledge and you are not going to be tested on that. But what happens is you cannot have an incomplete set of knowledge, because certain questions would require you to have a little overall idea about the Basel norms. So for that chunk, whenever you get your notes and you know everything, you will have an idea about that. Whatever extra stuff, even when the videos are going on, I'll keep on telling you, ye chapter kaise karna hai? How do you prepare for this particular chapter? During the videos also, I'll keep on repeating that part. That you know, for this chapter you need to study like this. There'll be a few chapters where I'll tell you read the key concepts first and then get back to the chapter. There'll be a few chapters wherein you don't need to put in that much effort. You watch the class, you just go through it once very roughly and that's all. You don't need to do more than that in the Basel section, right? Okay. I'll just very quickly go through the section. What are we looking at? In the first portion, first we try to understand those pillars. If you remember, you had those operational risk chapter in the first level, wherein we had those standardized, the basic indicator approach, the standardized approach and the advanced management approach. In the standardized approach, if you remember, basic indicator was your gross profit into 15%. Average 3 years profit into 15%. The second one, the standardized approach, divided your business into 7-8 categories and all those categories into 10%, 12%, 15%, 18% depending on the riskiness of the category. So those categories we'll study. What are the categories? What are the Basel pillars? What are the supervisory pillars? So we'll study all of that. It's very banking related. This subject is very banking centric. Are we okay? So enterprise risk management, you already know, I'm not discussing that. There's a little theory on that. Data aggregation, what is the importance of data? There was information data quality chapter we had done. So all those things are covered over here. What is operational risk data? What is governance, corporate governance, centralized reporting? So all those things are there in the first part of the theoretical portion. External data. Capital modeling is where we start with. Capital modeling, the chapter I told you, right? 44. Capital modeling, that is Basel. What did I make you mark in that? Capital modeling for 44. 44 is Basel, right?
No, 44 to
44 will be Basel. 44, please mark it under Basel. The operational risk supervisory guidelines, just a second. Capital modeling was 44. Standardized measurement approach, 45 is Basel. My mistake, 44, 45 is Basel. 44, 45 is Basel. 46, just write market risk beside 46. 46 we'll do with market risk, we'll not wait. We'll do 46 with market risk. We'll do 46 with market risk. 47 is a new addition. Model risk is going to be kind of a standalone theory chapter. Risk capital attribution and risk, you can actually write important beside that. Or you can actually skip. RAROC is also a very standalone chapter. It's a standalone chapter. Range of practices, that is reading 50, range of practices and economic, this part is again a standalone chapter. Then we have the capital planning at large banking holding companies. That is again, you could say it's a standalone, very theoretical, very boring chapter. Actually, that is also very theoretical, boring, standalone chapter. Capital planning at large bank holding companies. Then you come to the repurchase agreement and financing. That is very interesting. Again, it's standalone. It's not related to the other chapters as such. Repurchase agreement would be more to do with the central bank, the repo agreement, the repo rate, and all those things we'll study over here. The next part is going to be estimating liquidity risk. I've already told you. The operational risk, so we do not have a separate subject for the liquidity risk portion. The operational risk portion is going to be containing of the liquidity risk as well. When we talk about the first chapter, liquidity risk, so how much, say for example, I'll tell you that I have 10,000 shares of a particular company. The company's trading volume is equal to 50,000 shares a day. If you trade beyond 10% of shares, if a trade is beyond 10% of the total volume of the day, the total average traded volume is 50,000 shares. If the trading volume on an average, 10% is your trading volume on an average, 10% of trading volume on an average, 50,000 is the average daily trading volume. If you trade for more than 10% of that daily volume, the prices will be impacted. Because if you buy too many shares, the prices are pushed up because of demand. If you sell too many shares, the prices are pushed downwards because of the supply portion. Correct? Are we okay till here? Purvi? Okay. So yahan par what we are saying is, over here what we are saying is, if you trade for more than 5,000 shares a day, you are going to be impacting the market. If you remember financial disasters, long-term capital management company, because of my own position being so large and me liquidating my large position, the valuation of the company came down. Bolo, are we okay? So, if I have a holding of 20,000 shares, I need 4 days to liquidate the company without impacting the shares. There are a lot of ratios, very interesting content. There are a lot of ratios with respect to the liquidity part. Because one of the major reasons during 2007 crisis was less of the economy doing bad, the banks failing, and more to do with liquidity. Had you given all these participants a few more months or a year extra to make the payments, and there was not a panic in the market, we would not have had such a crisis. The major problem of the crisis was liquidity, and you will understand through this subject that why liquidity played a very important role when you're talking about the crisis during this phase. Right? So this is your liquidity crisis. So we study a lot of ratios, a lot of numerical portions, and it's a very interesting part. Then you get into the failure, assessing the quality of risk measures. So which risk measures are good or bad? That's a relatively theoretical chapter, standalone. Liquidity and leverage is totally related to the liquidity portion of it, obviously. So how do you measure liquidity, returns and all, calculations with respect to leverage as to how much of debt you should be using, how is your returns magnified, all those things. And the liquidity management portion. That is what you study in the next part. The failure of dealer banks is going to be talking about the liquidity concerns during the 2007-8 crisis. So the failure of dealer banks is going to be a part of liquidity. So I hope you've marked 55 to 56. 1 second. 53, 54, 54 is a standalone chapter. 53, 55, 56 is totally into liquidity, and even 64 and 66. I hope you guys are clear. 53, estimating liquidity risk. 54 is a standalone. 55, liquidity leverage. 56, failure mechanics of dealer banks. 64, Basel III liquidity coverage ratio, and 66, net stable funding ratio. 64 and 66 is also liquidity. So when you study or when I am teaching, we'll be doing all the liquidity chapters in a series. Even when you're revising, do it in a series, it will always help. Then you start off with the stress testing in the banks and all. That is quite a standalone chapter. Stress testing is a irritating chapter. Guidance on managing outsourcing risk is a new content that has been added. So we'll do it once we have it. 59 onwards, if you see, that is totally Basel. I'm not discussing the details. So Basel norms you already understand based on credit risk, current risk, market risk, credit risk. How much capital does the bank need to maintain? So basically when you're talking about Basel onwards, the whole Basel section, it boils down to the section as to how much of your equity does the bank need to maintain. Are we okay? Right? So based on the amount of risk, more the risk you take, more the amount of capital you need to maintain. A bank that takes more risk should be maintaining more capital, right? Because it's more risky. A bank that is taking less risk, that is doing its risk management very well, it should be maintaining lower amount of capital. It should get benefit of that. Why would a bank want to maintain lower capital? Because the return on equity will increase, na? Try to think. If the bank can maintain a small amount of equity and do so much of business, I will borrow from people at 7%, I will invest at 10%, all the extra 3% goes to equity. But if I have to maintain a huge equity, the same earnings will be divided by a larger base of equity, so your return on equity will fall. So the banks would always want to minimize the amount of equity that needs to be maintained so as to increase their profitability. If I can borrow more amount of money at 7%, invest more amount of money at 10%, I will be able to earn more amount of 3% on the larger base for the same amount of equity. So if I'm allowed to do more business, my ROE increases, my return on equity increases, and I would want that. I would want my ROE to increase, right? So the banks always want to minimize the amount of equity that is required. Now Basel tells us what was Basel 1, what were the problems with that, we move on to Basel 2, what modifications were made and we call it Basel 2.5, what again changes are made and which are proposed for Basel 3, and we are stated to implement Basel 3 going forward. Return on equity, trading on equity is basically when you take more loans in order to magnify the return on equity, that is trading on equity. But when you talk about the banking sector, we generally don't use the term trading on equity. Generally, we do not use the term trading on equity when we are discussing the banking section. So operational risk is a little difficult portion. People are generally scared of operational risk. Market risk seems to be the easiest. The first and the last book seems to be the easiest of the lot. Next is credit risk. And the most difficult people find is operational risk, not because the content is difficult, but because how to study, the understanding, putting the whole picture together, that becomes difficult with operational risk because the volume is relatively higher. You need to understand, you need to connect, actually, this chapter to this chapter. The reason why I'm giving you an outline so that you know, okay, which chapters are connected and how are you supposed to be studying becomes very important. Bolo, are we okay? Okay, we come to the last section. Risk management. If you see, just a second, let me open my book. So when you look at risk management, a couple of chapters have been added. You've got your factor theory and factors, 2 chapters have been added. Other than that, the alpha, illiquid asset, there is no section as such since it's a very small subject. So I don't have any section wherein I can, divide those 6-7 chapters because hardly 6-7 chapters given together. So basically what investment risk is about is when you are making investments, you are going to be tracking an index probably. We had done those things in the portfolio section of level 1. Foundations of risk management portfolio, tracking portfolio and all. Information ratio, I taught you that when I was discussing information ratio. That say for example there is a benchmark that is Nifty, or let's say a US index that is the S&P 500. Now manager is obviously going to utilize his own brains and buy, sell extra overvalued securities, undervalued securities, oversell, undersell, underweight, overweight compared to the Nifty. If Nifty or S&P has got 10% of one stock, your manager might take 12% because he thinks that stock is better. If S&P has got 8% of one stock, your manager might take 6% of that because he thinks that the stock is not going to perform better. So your manager is going to actively manage your portfolio and try to make some money out of it, will try to make extra profits. That is alpha. So studying that alpha, studying that extra return and the extra risk that the manager is taking is what we do over here. Value at risk of your portfolio, again we'll need to study of your investments over here. The next part, hedge fund, is going to be a very important part over here, because hedge funds you've not studied about in your level 1 curriculum. Level 2, your part 2 curriculum will be introducing you to what is hedge fund, how do the hedge funds function, what are the different varieties of strategies that the hedge funds use. So that is one portion that we'll be looking at. Otherwise, it's and how do you evaluate managers? Because when you're talking about risk management, say for example a manager You know about Sharpe ratio? It's not about the amount of excess return that you're earning. It's about the excess return per unit risk that you're earning. A risk adjusted measure of performance becomes very important. If I earn 5% above Nifty or 5% above S&P or Dow Jones Industrial or Nikkei or any of the stock indices, if I'm earning 5% by taking 2 units of extra risk and you are earning 6% by taking 7 units of extra risk, I am a better manager as compared to you. And if you are earning more percentage returns per unit risk, you are a better manager. Allocation of capital will happen. So will you allocate more capital to me or to the other manager who's earning low risk on a risk adjusted basis, a return on a risk adjusted basis? So allocation of capital and all will be happening according to that. If you remember level 1 enterprise risk management, the total risk of the organization is decided. Then the risk is allocated as to the organization's value at risk is say $2 million. So okay, department A can take risk of maximum value at risk $10,000. Department B $40,000. Whom will you allow to take more risk? Whoever is going to earn a return per unit risk at the highest level. So performance measurement and all becomes very important. So alpha, value at risk of investments, performance measurement of management, and the hedge funds part. That is what we study in the investment management area. That is your investment risk. The subject name is something different, but it is basically your investment risk. When you talk about current issues, your current issues total section, the total chapters have been changed. All the chapters are new in your current issues. The first, what we are discussing is Bitcoin. So you'll understand the technology, what is Bitcoin, what's the technology behind Bitcoin, you'll understand that. Market and funding liquidity. That again now dates back to funding liquidity. If you remember, there were 2 types of liquidity risk we had discussed. One was, liquidity risk is about what? It is not about being able to sell the asset in the market. If I want to sell, I had discussed this in level 1. If I want to sell a land of 1 crore rupees, I'll not be able to sell it at 1 crore rupees immediately. But if I sell it for 80 lakh rupees, I'll immediately be able to sell it at 80 lakh rupees because someone would want to take advantage of my bad situation, my bad poor financial situation, right? So basically, you can sell the land of 1 crore at 80 lakh rupees immediately. You can't sell it at its fair price. So liquidity risk is the inability or whether I'll be able to sell the asset, convertibility of an asset into cash at its fair price. The at its fair price portion is something that people miss out. The at its fair price becomes a very important part. Bolo, are we okay till here? Right? So that portion, so all those things we need to study, that is your funding, that is your normal liquidity risk. What is funding liquidity risk? When I want to raise money, will I be able to fund that? Will I be able to raise that money? When I want to raise money for certain reasons, for certain requirements, would I be able to raise that money or not? That is funding liquidity risk. So that portion again became a very important question during the 2008 crisis. So that is related to that. So that's something we study in that portion. That is your funding liquidity risk, comparing the market, the non-regulatory factors, funding liquidity and all of that. The next part, actually there's a new portion. The next part is going to be a market liquidity. Is it resilient or is it fleeting? Again, the liquidity portion becomes very important. The factors that is affecting the market liquidity, how liquidity spillovers can be there. Resilience of the market means as to if the market is facing a crunch. Today, say for example, demonetization has happened. Are we resilient enough to be able to manage and come out of the situation? Probably yes, probably no. Depends on business. Resilience, what do you understand by resilience? If I put you in a stressful situation, if I crunch you out of liquidity, suppose you are not earning for 6 months, will you be able to manage your expenses? Resilient, how resilient are you towards the market forces? Algorithmic trading is one chapter that has been introduced in CFA level 2 also. So algorithmic trading basically means, now you already discussed people like Nick Leeson and there was another person, Rogue Trader, the movie Rogue Trader was based on, and Nick Leeson was one, and the other one, there was another one you studied, level R, John Rusnak. So when you were studying about these traders, these financial disasters and all, they were basically traders. So what you understand by algorithmic trading is basically people try to develop algorithms or kind of formulas as to if this happens, then this will happen, and therefore the trade should be this way. So you are trying to understand a system, a formula, or basically trying to understand some kind of a logic behind the market that every time this happens, this happens. If you can predict that if event A takes place, event B will take place. You can actually build a formula, you can actually build a trade that will be able to profit from it. If I know that if A happens, B will always happen, then whenever A will happen in the market, I should do this so that I gain from the B event, right? So algorithms are developed. So that algorithmic trading is what we discuss in the next chapter. Then the electronic trading part, its implications. So basically the hanging up the phone, and so that is more of operational in nature, but use of e-commerce and all is what we'll discuss. Central banks' negative policy rates. We have seen certain countries of late having negative interest rates also. We'll study that. And the corporate debt in emerging economies. So when you talk about BRICS countries, Brazil, Russia, India, China and all, we are the emerging economies. Technically might not be exactly emerging. You can count more of the African nations, or Indonesia as an emerging economy, Turkey is an emerging economy. We might be a little further in the race of emerging economy. At least India and China could be relatively, a little way ahead in the emerging market race. But still, I would still consider that we people are the emerging economies, because here is where the growth lies at the moment. So when you're talking about the emerging economy and the corporate debt and how we can be impacting the whole global economy, in case are we stable enough? Is investing in emerging economy a good idea? So that section what we study in current issues. So current issues content, I'm extremely happy with the kind of changes they brought about, because even as maybe as lecturers, as trainers, as consultants in the corporate, we also try to understand as to what the economy is requiring, whether the change in syllabus is good or not. So both the CFA Institute changes that they've brought about and the level and the FRM changes that they've brought about is kind of good. The kind of changes that we are seeing is good. And with the environment moving on, with the kind of economy we are in, see, if you talk about Indian scenario, we had the BJP coming in 2014, we had our governor changed in 2013 and again in 16, we've got demonetization in 16, we've got recession coming out, we are coming out of recession, we've got private equity entering in a very big space in India, we've got a lot of, we've got a country like Greece going bankrupt, we've got companies like Apple and all who are so huge now that they can buy away nations altogether, we've got Nokia going out, Samsung coming in, Samsung going out and another OnePlus coming in suddenly from nowhere. We've got the whole app market over there. We've got the technology changing like crazy with the 3G, 4G, 5G, 6G, God knows what. The political scenario, the financial scenario, the economic scenario, the social scenario in countries is changing so quickly. The metamorphosis is so quick that you need to be able to adopt. The amount of changes in syllabus is actually happy. There's so much of excitement in the economy right now. Start reading. Immediately start reading. You need to be updated with the news. You need to be updated with reading. Reading is the most common habit in successful people. Google up any top 10 things successful people do. Reading is going to be in the top 3. Always in every blog. Don't trust me. Google it up and see. So obviously content, the whole syllabus is my idea, is my responsibility. But at the same time, it's your responsibility. It's also my responsibility to actually push you. Because you are already in jobs or you're going to be looking forward to jobs or changing jobs, switching profiles or something. Your FRM designation will get you to the interview table probably. To the correct designation, to the correct profile. But cracking that is going to require all these things also. If someone questions you, what is your take on the banking area? What is your take about the demonetization? What do you talk about? So you need to be prepared with that part. That's very important. Right? Again, getting back to my part. So basically I was discussing this because current issues, what they've revised is very, very concurrent. It's very contemporary. It's very now. So I'm very happy with the syllabus as such. Now when you're going to be studying, you're going to be doing your class. If it's the live class, you attend your class. If it's a video class, you watch a lecture. Once your lecture is over, let's say one chapter is over, you study that chapter by yourself. You put your markings. I'll make you mark a lot of things. I'll make you underline, maybe not underline exactly, but a lot of extra notes or whatever extra is needed to be given, I'll be giving that. I'll be making you write a few things in short, giving you extra stuff. Along with that, while you're studying, please keep underlining. Please keep writing some things in small. Say, for example, this whole paragraph, the summary is only 2 lines or something to remember. The remembering part is only 2 lines. Write it beside it. Because when you're going to be studying for the exam, 85 readings is not going to be possible to revise that easily. Right? Key concepts is there behind the chapter, but it's always easier to study from what you have shortened and what you have written. So shorten the content, your class is done, you shorten the content, you read the content. Behind the chapter questions, I'm not even counting it as practice. That is 4 or 5 questions easily given. You can do those. You have a Schweizer book which will have 2 papers given. You can do that towards the end, because the problem is that FRM curriculum will have the questions jumbled up. The questions in Schweizer practice paper would be jumbled up. You will get practice papers from my side. It will not be the hard copy that you'll get, the textbook that you'll get for practice. That will be more of a jumbled up questions. You'll have jumbled up questions, subject wise at least. So you'll have subject wise papers, you'll have full length mock papers. That will be the practice book that will be given. Along with that, in the soft copy format, I will be sharing with you 2 different kinds of practice exams, practice papers and all. One will be the easier one will be more difficult one. We will provide that to you. You will have chapter wise questions in both. I will divide those, categorize those in subjects. I will divide those under priority. That this chapter, this practice one you have to do. This practice one, if you have time, you do that. Priority 1, priority 2, priority 3. So first priority has to be done. Second priority you should try your best to do. Third priority, for those who have time can do it, others can leave it. Because it's not possible to do everything, it's not possible to practice everything. But a decent amount of practice would be required. Practice material is totally my responsibility. You do not have to purchase anything extra. All you need is your Schweizer textbooks. So that is your studying part. You watch the class. While doing the chapter, for every chapter I'll tell you what is important, how to study this chapter, and I'll explain everything. So that will not be a problem. You study the chapter, try to complete a current issues and investment risk first, because once these 2 are covered, you can start practicing these 2, because smaller part, easy to cover, and you can start with practicing these subjects. So we'll try to cover these 2 first, then we'll start with market risk, then credit risk, and then operational risk. That is the kind of order we'll move into. The reason why I want to do operational risk is a little later is because it is more theoretical in nature, so retention would be better if you do it towards the end. But a lot of people have a problem that, too much of theory again will get very annoying. So what I would suggest is you could keep 2 subjects parallelly. So maybe a current issues is going on and you're doing a little bit of operational first, then current issues is over, maybe a little bit of operational. So suppose I do a current issues. I do one chunk of operational, the 3-4 chapters which are theoretical, easy theoretical. Then I again get back to investment risk, I do this portion. Then I again get back to operational, I do another chunk of that. And I just leave Basel towards the end. Then I start with my market risk and then I get into credit risk. Or vice versa, either ways. Maybe I'll do the current issues first, then investment risk, then credit, then market, then operational. So you can structure it accordingly. The subjects are not going to be interrelated as such, except for a couple of chapters. Your operational risk, your back testing of VAR would be required in operational risk. Your back testing of VAR in a couple of terms. Back testing VAR will be required in operational risk. So back testing VAR needs to be done earlier. But other than that, the chapters or the content is not interrelated. Rather theoretical, more numerical, theoretical but more current. Part of it is numerical. These 2 subjects are similar on the grounds they have, little numerical, practical, formula oriented side and a lot of theoretical side. Operational, you hardly have any formulas apart from the liquidity chunk. Liquidity is a very interesting chunk. Investment risk is interesting, part theory, part practical. Current issues is current. It's very practical in the approach, but there are not numericals. So if you see numerical, you'll find it in these two subjects. That too, it's going to be very restricted compared to level 1. So that's about your classes, about 110 hours of classes, 100 to 110, 120 ho jayega, 85 chapters, because chapters have increased, 100 to 120 hours of lectures. So based on the amount of time you have, leave 15 days at the end, divide the number of days, according to that, cover your lectures. Once a subject is over, suppose current issues is over, now you start practicing current issues. The chapter-wise questions you can start practicing alongside. If suppose current issues is over, then you can do my practice book questions. There is no limit to complete. You can have Schweizer questions, you can have other questions, the other practice material I'll give you. You can have the textbooks to cover. You can have the GAP paper that the institute is going to give you 20 days before the exam. So there is actually too much to do. You cannot possibly do everything. You understand that very well. So what we need is, that is why I'm telling you the practice portion, I'll sort it. I'll give you a whole list of, these are the things you need to do, these are the things you should try to do, these are the things you may do if you have time, otherwise leave. So practice portion will be explained. So you practice the questions behind the book. After that, you do the chapter-wise questions that I have shared on soft copy. Once a subject is over, you can do the whole subject questions that's there in my textbook that I'll provide. Are we okay till here? And the mock papers will come in a little later towards the end. Do not do the whole content first and then start practicing. Try to keep your, let's say for example, I have 120 hours of classes or 110 hours of classes. Try to do 10 hours per week, 11 weeks, so that you have a little head start towards the end. You have an extra time towards the end. Or what you can do is, instead of 11 weeks, you take 13 or 14 weeks for 110 hours of lectures. So what you are doing right now, you do your practice along with the chapter. So chapter, you watch the class, you do the class, you do the chapter from the book, and then you do the practice of that chapter. Right? But try to maintain that. Do the practice along with it. You will not be able to do all the practice at the end. That will not be possible. So try to do at least, let's say I'll complete 3-4 chapters, then I'll start practicing. So I'm studying one day, I'm practicing for half an hour. Don't keep like a study then practice and study then practice. It does not work. That I'll study on Saturday, Sunday, and Monday to Friday I'm practicing. All those things don't work generally. Try to study for 2 hours and then practice for 15 minutes, half an hour or something. So even the recapitulation will happen. So that is how you need to study. Anything that I'm missing out, the exam pattern I've discussed, don't even dare to cheat in the exam. I have cleared all those things in FRM part 1. I'm just repeating a few things because they'll not tell you that you're cheating. They'll mail the institute and then you'll have to answer the institute. So no point cheating. You don't even know that the other person is prepared or not. If you're attending the classes well, then you'll not need to cheat. So that will not help. 2 to 6 your exam is there, you know that. Paper pattern is MCQ, you know that. Rough work, you can do it on the question paper, you already understand that from FRM Part 1 exam. Schweizer books you'll need to purchase, you understand that. I think more or less syllabus you understand now. You can shuffle between the subjects, you understand that. Try to keep a theory and a practical together. Try to do chunks, like you do one chunk. These 2 subjects, do it pura ka pura subject, do the whole subject together. And in these portions, you can do one chunk, then move to another chunk over here, then another chunk over here. So chunks, don't switch too much. Don't do one chapter here, one chapter here, one chapter here. Don't try to study 2 subjects at the same time. If you're irritated with this, you do a simple small chapter over here, that all is understandable. But in general, when you're talking about the order of the syllabus and study of the syllabus and all, try to do one chunk together. Try to do the block of chapters or the group of chapters together.
What about the access to
Access to core readings,
co-readings?
the core reading, the extra part we'll cover, but what happens is that apart from all this that you'll study, apart from the practice that we'll be sharing, you'll not have time for core reading. So I don't suggest my students to buy the core reading hard copy or anything. If there's any extra stuff, explanations and whatever is needed, I cover that part. So core readings as such you'll not be needing and you'll not be able to cover. Practice is going to be more important. You'll need to cover your content over here and the practice, whatever I'll be providing you, you'll need to do that. And the practice portion will be sorted and given. Will be sorted, prioritized, and all that folder will be renamed and a whole notepad. I mean, I'll share a note how to practice. So you'll have all that given. Tell me, are we okay till here? Anything else that I'm missing out? If any questions you have from your end? For the video class students also, those who are watching, you can just avail the classes. The details will be there underneath. And whatever details you need, you can always WhatsApp on this number. And you can get the details. You can always WhatsApp here. And there are other lectures, the market video, a couple of market risk, a couple of first chapters classes or something are uploaded. So you can view those lectures also. Right. I hope you are sorted with the content. I hope you're finding it relatively interesting. Problem? Not interesting. No, yeah, current issues and all, they've improved this content. They've added a few decent chapters, but I think the volume has increased. We had around 78 lectures earlier. Now it's become 85. It's necessary to adapt to the market. Absolutely. Absolutely. The current issue, the Bitcoin and all those things that they've included, it's quite interesting. So basically 2007 crisis is also becoming outdated now. So you're moving forward very quickly. So you need to be very much in sync. So I hope you understood all these things. Looking forward. Don't mug up. Mugging up will not help. It will not take you through the exams. Questions are not going to be straightforward. Questions are going to be very applications or concept based. Analytical. So you'll have to understand the content really well and it will take time to understand. Like level 1 was relatively easier to understand compared to level 2. I'm not talking about the quant section or the hypothesis. Like I'm comparing it with like chapters like operational risk, stress testing, country risk. You're understanding those chapters when you compare it. There's going to be a lot of understanding, linking, and those things will be important over here. It's not going to be more difficult mathematically as compared to hypothesis or a multiple regression or a copula or something. It's not going to be more difficult on that ground. When you compare it to those rating agencies, internal rating based, there was this internal and external rating agencies and all those, it's going to be difficult than that. So you'll have to understand, there's going to be a lot of things to understand, and the implication, questions will be on that ground. Bolo, are we okay? We'll keep it till here for the day. Thank you.